Hey everyone, and welcome back. So with 2021 just around the corner, I know that a lot of people towards the end of the year start to think about what goals they want to have leading into the next year. And one of the key and most common goals that you hear people saying is they want to start investing and start to manage their personal finances better. So in today's video, I'm going to be sharing with you 5 beginner tips if you want to get started investing in the stock market. And this isn't just going to be exclusively for people who want to analyze businesses and get into the numbers. So if you are just a complete beginner, you've never invested before, but you have some money around or you're planning to invest in the next year, today's video will serve you well in how to get started regardless of what type of investor you want to be. And speaking of what type of investor you want to be, that is the first tip. You should be trying to figure out what type of investor you want to be. And that might sound a little bit stupid if you've never kind of looked at investing before, but there are a few key ways that you can invest your money depending on how much time you want to dedicate to looking at your portfolio and a number of other factors. So the first thing you want to decide is whether you want to be a passive or an active investor. So a passive investor is someone who just wants to participate in the market, but you're someone who doesn't want to dive into the numbers and be constantly keeping up with the news of the economy and individual businesses, because there is actually a way that you can just consistently contribute to an investment and you really don't need to be in the know of what is happening specifically in the economy at that point in time. And the way that you want to go about investing if you want to be hands-off is by investing in what's called index funds. So these are set up by big funds such as Vanguard or BlackRock. And basically you're investing in a single stock that then gives you investments in a basket of businesses that track a certain index. So for example, you can invest in a Vanguard index that tracks the US market, the top 500 businesses in the US market. You can do the same thing for the Australian market. And there's a bunch of other types of indices such as tracking world markets or emerging markets, underdeveloped countries that are growing at a high rate. And the idea behind investing in broad ETFs, broad index funds, is because you're getting a basket of businesses that tracks an index, it is very, very unlikely that over the very long term, you will lose money on that investment. Now, there can be short periods of times where the US market is down or the Australian market is down. If you've been watching the news over the past year, you would have seen that in March, there was a significant decline in both the Australian and the US market by almost 40%. But over time, over the long term, over 10, 15, 20 years, over your investment horizon, that group of the largest businesses in a free market economy like the US or Australia will be able to innovate, reduce their costs, and provide better products and services for consumers, which grows those businesses as a group over time, even though on an individual business basis, some of course will fail and some will succeed. And historically, this has been very, very lucrative to investors, right? So ETFs and index funds actually haven't been around for very long, but we of course have the performance of those certain indices, the group of, say, the biggest businesses in the US. We have the performance of those businesses for more than 100 years. And if we look at the Australian market, for example, looking over 110 years, the Australian market has grown on average by about 13% compounded per year, which is a terrific return. Now, there's no guarantee that the past returns will look the same in the future, but consistently over time, regardless of whether it's 13% or 6%, the broad Australian market or the broad US market has grown over time. So if you want to be hands-off and not all in the numbers every single day or every single month, then this is probably the best option for you. Now, passive investing is probably going to be applicable to probably 99% of people who want to invest money, but there are a small group of people and probably a higher number of people watching these videos, because I talk about it all the time, that want to invest in individual businesses to try and outperform that index, to try and get a better return. If the US market has returned, say, 12% per year over the past 10 years, individual investors who want to pick individual businesses are trying to find the small number of businesses that do better than average and therefore can grow your money at a higher rate. Now, of course, if you want to be picking individual businesses, there is going to be a lot more that you need to learn and a lot more that you need to be focusing on in terms of looking at the numbers in the business and how they're growing over time and estimating what the competitive landscape is going to look like for businesses in the future and whether a business is going to go from being a small player to a big player or a big player to maintaining their competitive position. There's a lot more to think about and a lot more hands-on work, but of course it is far more lucrative if you can pick really good investments over time. You can do much better than the market average. So the second tip that I want to talk about today is what you should be doing if you want to be that passive investor, which, as I said, is going to be the vast majority of people out there. The first thing that you want to do before you start even looking at investments is you want to start tracking your income and expenses. So whether you're using some kind of app or your bank might have some kind of feature that allows you to do this, or whether you just use a spreadsheet that you've created, you want to start tracking your income and expenses and looking at your income for areas where it can be improved, if you can have a side hustle or if you can move into a higher paying job in the same field or whatever it is, and also looking to reduce your expenses where possible. So just overall having a better picture of what your personal finances look like so that you can make improvements as it is right now, and then look for areas where you can set money aside to invest. And then what you want to do is you want to figure out a set percentage of your income that you're always going to set aside every single week or every single month towards your investment portfolio. And it's really, really important that you set a percentage and you stick to it. That is kind of the first thing that you do whenever your income comes in. It's not that, your income comes in and then you have all your expenses, you buy yourself some things, and then if there's something left over, I will put it into a portfolio. That's really not going to cut it. You need to be setting a percentage up front, and that money is gone, right? You take it as if it's kind of a pay cut on your income before you even consider paying for any of your expenses. And then what you want to do is, of course, you want to pick the ETF products that you want to then go on and invest in. And I would just set up a Google Calendar for every month or every 3 months and set how much you're going to be contributing every single interval, right? So if you're investing quite a lot of money, it might be every single month or every couple of weeks. If you're only investing a small amount, a couple of thousand per year, then you probably want to do it in every 3 months or every 6 months or something like that. But the idea is that you set up a schedule so that you know exactly how much money is going from your income into your portfolio, and then you know exactly when to invest so that you're not trying to predict when is a good time to invest. You just want to invest consistently regardless of what the market is doing, regardless if it's all-time highs like we saw in January of this year, regardless if it's 30% lows like we saw in March. It doesn't matter. You're not trying to predict what is going to happen or where the market's going to go over the next 6 months. You are just adding consistently, knowing that over the very long term, those indices should go up. So the third tip I want to talk about today is in regards for people who are active investors, which, while, as I said, is a very small percentage of people broadly, for the people who follow this channel, it's probably going to be a larger percentage because I do talk about how to analyze businesses on the channel all the time, and I break down the numbers and that sort of thing in pretty much all of my videos. So if you are an active investor, the first thing that I would suggest, which might seem strange to you, but I would also set up a passive investing strategy like I just spoke about. And the reason why I think this is a good idea when you're getting started is because it allows you to form a foundation of your portfolio that will not be impacted by your individual stock picks, right? So if you pick some terrible stocks, you will still have this solid foundation in your portfolio that will consistently go up with the Australian economy or the US economy or the world economy or whatever it is. But basically that part of the portfolio can be whatever percentage you feel comfortable with, right? For me personally at the moment, it's about 10%. So 10% of my money is tracking the markets, the US and Australian markets, and then about 90% is in cash and individual businesses. But if you're just getting started, you could start off with 90% of your money going into an ETF just passively, and you know that it's relatively safe. And then you can leave a little bit of your portfolio to mess around and try and find some good individual businesses that will boost your overall returns. The reality when picking individual businesses is that really, really good, safe, great long-term investments do not come around very often. For me, it seems that I've been able to find one per year that I've been investing. Sometimes it's going to be even less than that. And sometimes when the markets are down significantly, you're going to be able to find multiple opportunities, but you need to have have significant amounts of patience and discipline when it comes to picking individual businesses. So having money consistently going into a passive strategy like an index fund while you're looking and waiting and learning about how to find opportunities makes a lot of sense, rather than just rushing out and building a portfolio of 8 stocks that you haven't really researched well. You're far more likely to do better if you take your time and recognize that long-term investing is a long game. You're going to be investing over many, many decades, or at least 1 decade for the vast majority of people. And as a result, it's a good idea to build your foundation and take your time when picking investments. For me personally, when I started building my current portfolio, which is where all of my money currently is, I started off by investing in an ETF, and then I just looked for one really good investment, right? And when I found that one good investment, I put a little bit of money into it, 5, 10, 15% of my portfolio, and the rest was in that index fund. And then I started looking for another one. I was focusing on one good stock at a time, and I wasn't rushing out to build a portfolio of 10 businesses straight away, because that's really, really unrealistic. And now here, about 3.5 to 4 years later, I have a portfolio of a number of really good individual investments that took a very, very long time to find. And I still have that foundation of the ETF. And I know that over the next few years, I'll be able to continue to build the portfolio to the point where I'll probably still have the foundation of the ETF or index fund at about 10 or 15% of my portfolio. But the remaining of my portfolio should be in between 6 and 8 really good investments that I thoroughly understand. The fourth beginner tip here for investing in 2021 is that you need to be tracking your performance. You need to be tracking your portfolio, right? So many people have money in 3 or 4 different trading accounts. They have cash here, they have ETFs here, they have stocks here, they have US businesses that are in US dollars, they have Australian businesses in Australian dollars. And unless you're putting that all into one piece of software or one spreadsheet, there is no way that you are actually tracking how you are performing over time. So what you need to do is you could either set up a spreadsheet that you could find a template for, or you could do it yourself. But honestly, the easiest thing that you should be doing is using something like Sharesight, which is a sponsor of the channel, just to be completely transparent. But using something like Sharesight to just enter in all of your trades and consolidate your entire portfolio. And it will basically allow you to track your capital gains, so how much the stocks are going up, your dividends. If you have dividend reinvestment plans, it will track all of that for you. Don't worry if you don't know what that means. And then it'll also automatically track currency, which is a huge lifesaver if you're investing in foreign markets or you just have foreign currencies, because currency gains can have a significant impact on your returns. I think some of my investments that I made in March in the US, March of this year, that were of course invested in US dollars, some of those investments have experienced negative 10% just on currency. So if you're not tracking that, you might think a stock is up for you when in fact it's down, or a stock may have actually performed much better for you because the currency has moved in your favor. Now, of course, you can try Sharesight for free. They have a free plan. You can also use my link to get 33% off a yearly subscription if you want, and you may be able to use it as a tax deduction, and it'll probably save you a ton of money at tax time if you use it to do your tax. You guys know that on the channel, I don't really promote anything. The only thing I promote outside of my own stuff is Sharesight, because I've been using it for over 3 years. So I highly recommend you go check it out if you want. As I said, try the free plan for as long as you want. And I also did a full feature review in a video, and I'll link that down in the description below as well if you want to check that out. And then the fifth and final tip for beginners when investing in 2021 is that you should never stop learning. You should always be trying to learn more, because there is always things that can improve your investment strategy, whether you're a passive investor or you're an active investor. So starting with active investing, there are a ton of really great value investing books that you should read. The Essays of Warren Buffett is my personal favorite, so go check that one out if you're interested. Watching things such as my four-step stock analysis playlist, that's a mouthful, 4-step stock analysis playlist on YouTube. I'll link it down in the description below. Those go through some videos of how you can analyze individual businesses to make really safe and solid long-term investments. And if you're interested in joining me and a community of 300 students where we work through stock analysis and help you improve over the long term, then you can also join the waitlist for Learn by example, which will be opening in January of next year. You can use the link, join the waitlist, and I'll send you an email when it's available. And then in terms of if you're a passive investor, there are still things that you can do to expand your knowledge. Reading things such as The Barefoot Investor is a really great book for being able to learn what you should be doing as an average person who doesn't want to be super hands-on in their finances, but just want to do things a little bit smarter so that they can save themselves some money and grow their wealth over the long term. There's also a ton of really, really good YouTube channels that go through how to manage your personal finances, how to create budgets, how to improve your income streams and diversify them, and also how to reduce your expenses. And just having more attention to your personal finances will just immediately save you a bunch of money. Just tracking your income and expenses, it's amazing how much you find that areas where you're wasting money that you can, once you see it, you can just immediately eliminate it. And the same thing goes for on the income side. So I hope you guys enjoyed today's video and got some value out of these tips. As always, I'll be down in the comment section answering questions and answering comments as this video goes live. So if you want to head down there after the video, I'll meet you down there. If you enjoyed it, leave a like on the video and hit subscribe, of course, if you want to see more content. There'll be plenty of content coming out in the next year and beyond. So do that if you want to stay up to date with all of the different types of investing, but mostly active individual investments. But besides that, I hope you guys have a great day, and I'll see you in the next video.